Sam,
What's happening, Bill?
we're here. We got Shop Talk with Sam and Bill today. And I am super excited because uh, Sam and I have been business partners for 12 years, and he is one of the smartest guys I know. And it's just, your education, all that stuff. And you're a real student of the mortgage industry, yeah, and a nerd too. I mean, show him your glasses. Let me show him those
Hey,
glasses.
well, I need these. I need these to be able to see close up now because
Yeah. I mean, those are like, I love those glasses. Those are
they're
like
the best ones. I have about 20 pairs laying around my house.
you got about 20 pairs.
Yeah.
Those things are awesome. So, anyways, you can put them on anytime if you have to see anything. But,
All right.
anyways, we're going to have some fun today. Our topic today is forbearance, and there's a lot of information going out there. Some of it is just not the right information that some of our clients need to know. And we want to make sure that we get the right information out there so that they are completely aware of it and understand what they're getting into. But first, I want to talk about, I appreciate you obviously as a business partner. We've had a lot of fun over that time period. And, our whole goal is to really educate, communicate, and empower people to make smart decisions on their financing. We know that they don't do it every single day. We do. And really, our whole goal is to educate. That's the biggest thing. And if they're educated, then they can make smart decisions. And we're here for them in the long term. So last month, we we helped 100. How many families did we help last month? It was
165 families last month from everybody working from home, which is really interesting. And it's stuff that we learned really fast and figured out that we can do it. And we really have had a tremendous opportunity to help people during this time. I mean, we always talk about educating people, communicating, executing on time, getting them in the right loan. And, we always talk about our real job starts after the loan funds. And when we see some of the things happening right now, literally as we speak, with people calling servicing, putting their loan into forbearance, continuing to making payments, understanding that your credit's not getting hit with a 30-day late, but it's showing other things that are going to have really significant impact on you. When we were talking yesterday, Bill, we were just like, man, we somehow have to get this word out to as many people we know, friends, family, all of our past clients. We just don't want people down the road to look back and say, darn it, I wish I wouldn't have done that if they didn't have to. So I love talking about this. I want to get the message out there. And I really want people to understand the consequences of putting their loan in forbearance.
Yeah, well, I can't wait to get into this. And by the way, one of your buddies, Kevin Fury, is saying hello.
Oh,
You got a fan out there. We got one fan, so this is great. So Sam, let's talk about forbearance and what it is and what it means and kind of what's happening in the marketplace with forbearance. So just forbearance, what is it?
Yeah, I mean, the CARES Act, which was passed in response to and as a stimulus to the COVID-19 crisis, had a provision in there to allow people to not, basically postpone up to 6 months of mortgage payments and possibly another 6 months for all government-backed loans. Government-backed loans means it's an FHA loan, it's a VA loan, it's a Fannie Mae loan, it's a Freddie Mac loan. Not all loans are government backed, but most of them are. So most of them are impacted by this. And, the provision is to help people that are impacted by this crisis, people that are going to struggle, that have lost their job, that have that might not have the ability to make their payment. And that's what it's for. And I think it's a great provision. I just wish there was a little bit better communication as this provision went out there, because it doesn't require proof of a hardship. Most of the time when loans go into forbearance, and by the way, forbearance does not equal forgiveness. You might have read that on the internet or heard that from other people. It does not equal forgiveness. It's basically postponing payments. The technical definition is postponing payments for a certain a certain period of time. So as an example.
Before I want to interrupt, and that's different than deferment, correct?
Correct. Deferment means that the payments that you don't make get added on to the end of the loan and extends the term of the loan, which could be possible after forbearance. But there's a lot of things possible after forbearance.
A lot of things that can happen in there, huh?
Yes, yes. I mean, first, for people that need it, call your servicer, understand what it means, make sure you have all the information you need to make a good decision. But surely, if you're impacted by this crisis, like so many people are, this is meant for you. And you know,
I was going to ask you one question. So if somebody is struggling, maybe they've lost some income through less tips, or they have or their employer has reduced their income, and it's a little bit more difficult to make that payment, but they can make it. Is there a recommendation you would give for that?
yeah, I mean, I think my advice to anybody that can hear me or that call us is it's a last resort thing, and we're going to go through why in this session here. But to me, it's a last resort. If you can make your payment, pay it. And let's just go through and back up from a technical standpoint. Let's say somebody's payment is $3,000 a month, and they're going to go in forbearance for 6 months, which the CARES Act allows. So they're going to postpone $18,000 of payments. Well, technically on the 7th month, that $18,000 plus the 7th month payment is due. So if you pay $21,000, you're good. You're caught up. You went through your forbearance period and you're back to normal. But most people are not going to be able to do that. I mean, if they can't make their payment now, I think what most people think is that, hey, I'm going to just take advantage of this provision and I'm going to improve my cash flow without thinking about the consequences. And for people that need it, it's a very good solution. 100%. But if you can make that payment as a last resort, or if it's a last resort thing to go into forbearance, because if you can make that payment, you should, because even if the provision dictates that the credit bureaus and the servicers will not hit you with 30-day lates, they will not show your loan as delinquent. This is all true. You won't have to pay interest on the interest. You won't have to pay penalty fees. The provision specifies this. So everybody's like, well, hey, it's not going to affect my credit. It's not going to show 30-day lates. It's not going to be penalties. It's not going to show fees, and I'm not paying interest on interest. Then I'll take advantage of it. But when we pull your credit in the future, whether you're in forbearance, right after forbearance, it's not going to show a 30-day late, but it's going to show us that you were in forbearance. And the way we know that is because the credit reporting agencies provide payment history. And when you look 24 months back in payment history, and it shows that there were no payments made for 6 months, a whole bunch of other things kick in. There's a bunch of provisions in all the selling guides to get future loans and to refinance that are going to prevent you from doing what you might want to do in the future. And the biggest one for most people right now, Bill, is that we believe rates potentially can go, potentially really low. And we want people to be able to take advantage of that savings if that happens.
So Sam, it was really interesting to me. We were talking a little bit yesterday, and the statistic that you threw at me, that 43% of people, within actually Loan Depot that are in forbearance are actually still making their payment, right?
Yeah, so I did hear that from a good source in Loan Depot. So even if the number's not exact, what it's showing is that people are calling and putting their loan in forbearance in case they want to stop making that payment. And what happens is it shows their loan in forbearance, but it shows them current and it shows them making that payment, but the damage is being done by showing forbearance. So let's give an example. Somebody goes into forbearance and doesn't pay 3 months worth of payments. Even if they catch up after the 3 months, they're going to show that they didn't make payments for 3 months. And Fannie Mae, Freddie Mac, and other guidelines will dictate that after you catch up, there needs to be 12 months of showing you paying on time before you can get another loan. Whether they change that in the future for this crisis is yet to be known, but there's a whole bunch of information out there on you. And as lenders in the future, and it's not just mortgage lenders, your credit score dictates your credit card interest rates. It dictates your auto loan rates. It dictates you getting credit cards and auto loans. It dictates your insurance premiums. It dictates your future mortgage loans, your future mortgage purchase loans, or your refinance loans. That 3-digit number affects so much in your life that people don't realize on the surface. And when people put their loan in forbearance because they want to take advantage of this provision and they don't think about all these other consequences, it's something that I think people are going to look back and say, darn it, I wish somebody would have told me this so I could have made a better informed decision. So that's really what we're doing here today.
So we're still in that unknown period where we just don't know what's going to happen in the future and how, is it a little bit of a black mark against them for going into forbearance if they didn't have to? And like you said, Sam, if people need to go in, there's definitely hardships. People need to go in and absolutely take it. Now, can they get out of forbearance?
Yes.
Time? How does that work?
You can call your servicer and say, hey, you know what? I made a mistake. I want to get out of forbearance. Take my loan out of forbearance. And if you haven't missed any payments, it will show you that you weren't late, and they'll take your loan out of forbearance. Usually takes 30 days or so, and the credit reporting will come back and show that your loan's in good standing. So if somebody has put their loan in forbearance because they think that they just might want to use that provision in the next 3, 4, 5, 6 months, and you haven't missed any payments, but you can make the payment, and you listen to us today and you're like, oh shoot, you can call your servicer and you can take it out of forbearance, and chances are it'll be okay. But if you look at the bookends of people, and this is really what's happening, you have the person that is definitely impacted by COVID-19, whether they lost their job, income got cut in half, they're ill, whatever the case is. That's why this provision was there. You have the other extreme, and there's real live examples today of this, Bill. Somebody just closed on a loan. They took $250,000 cash out of their equity. So they paid off their old loan, they get a new loan, they get $250,000, and they're both, let's say it's a husband and wife, and they're both still employed. They're not impacted by COVID. They still have full pay. They're still fully employed, yet they call and put their loan in forbearance. So there's a whole bunch of things behind the scenes when mortgage payments aren't paid. Servicers still have to make that payment to the investors and to the end bondholders. And so there's a big problem for mortgage companies that service loans to have to provide that cash flow during these forbearance times. And for them to deal with that, depending on how many people go in forbearance, will affect everyone else. Because if you think about it, if loans are in forbearance right after they fund, there's a really, really high cost. We won't get into the super complex details, but there could be $20,000, $35,000, $40,000 of cost to that loan that the mortgage company will have to basically absorb if a person funds a loan and goes into forbearance right away. So it's very important for people to understand the consequences of this. And if you think about the people that do not go into forbearance, well, I'm not affected by that because I didn't put my loan in forbearance. If we don't educate people and people don't understand this, it does affect everybody, because mortgage companies will have to price in order to absorb these losses. So it's something that we need to really pay attention to and get the word out on how this affects you.
And Sam, I know that there are some people that have investment properties, and I know that there's our renters that are not able to make some of the payments, and I certainly understand that sometimes there's a hardship on someone who owns rental property. And we were discussing that somebody that one of our clients, wasn't one of ours, but somebody had done it. They went into forbearance on the investment property, but now it's preventing them from refinancing and taking advantage of lowering their monthly mortgage payment by doing that. So explain that a little bit. Is that something?
Yeah, no, it's a great point. So if you call a mortgage servicer or a mortgage company, your mortgage servicer, and you say, first of all, like we talked about before, it does not require proof of a hardship. All it requires is a verbal attestation that you've been impacted by the COVID-19 and you need to take advantage of this forbearance provision in the CARES Act. So if you put any property you have in forbearance, you are telling the mortgage world and the credit world that I am impacted by COVID-19. Well, if you are, you're not going to be able to get any future loan on any property. because you've already attested and you've already told the world, the mortgage world or the credit world, whether it's auto loans, credit cards, mortgage loans, and we're specifically talking about mortgage loans right now, but you're basically saying that I'm impacted. So therefore, if you're trying to get a loan on your primary residence and you're going to save $450 a month on the historically low rates, but your investment property on your credit report shows that it's in forbearance, you're not going to be able to get that loan, because our job as a mortgage company is to analyze your ability to repay a loan. And if you've attested that you've been impacted by COVID-19, you're not going to be able to get any loan. And so that's the reason we really need to make sure people understand this. And again, let's go back to the scenario. $21,000 due in 7 months. It's likely somebody's not going to be able to pay $21,000 in 7 months if they put their loan into forbearance. So what happens then? If you can't pay it all at once, your loan is going to go into normal loss mitigation waterfalls. Can they increase your payment to make up for it? Can they modify your loan terms to make up for it? Can they put a secondary lien on that sits there so it'll be paid off later? All these things are a form of delinquency and default. So it will affect your credit report. It will show, if you get a loan modification, it's going to show that your loan was modified because you had a problem. These are all forms of delinquency and default that are going to show on your credit report in the future, even though your mortgage servicer didn't report you as 30 days late or 60 days late or 90 days late. All the information's still there, and it will affect your credit report. And if your score does go down, it's like I said, it's going to affect so many other parts of your life. Auto loans, credit cards, insurance premiums, the refinance opportunity that you are likely going to have in the next 2, 6, 9 months, 1 year. We've talked about this before, Bill, in the past. I mean, it's been said that somebody with a high credit score versus a low credit score could be as much as $350,000 more in a lifetime, based on higher interest for all the things that we need as consumers throughout our life as far as credit. And it's all based on your credit report and that 3-digit score. So we want to protect it. We want your equity protected. Equity position in the United States is at its highest point ever right now. There's more than 50% equity in the country's housing world. So more than 50% of homes are owned. That's a lot of equity and a lot of wealth. And people need to know that they can't put that equity at risk. And when you start to go into loss mitigation waterfalls and you start to go into loan modifications and forms of default and forms of delinquency, you're putting your equity at risk. And we really want to prevent people from doing that.
So Sam, that word loss mitigation waterfall, it's kind of scary, but
yeah.
If I took a basic scenario, let's say, for example, and I think that, certainly, hopefully the unemployment is a temporary thing. And we've been off a month and a half, 2 months, maybe another, 2 or 3 months before other industries get back. So let's say they are delinquent or not delinquent, but they went into forbearance for 4 months. They get their job back and then they can start making their payment. What happens? How do they figure out how to get out of forbearance? Let's say they don't have the money because they didn't have the money to pay the mortgage anyway. What will they do with their lender to really get back on track? And you talk about that waterfall. I'm just going to go with, I don't like the word loss mitigation, but let's go with waterfall.
Well,
let's talk about, probably the most likely scenario is doing something like a repayment plan, correct?
Yeah, I mean, not every servicer is the same. There's different contracts, different covenants. I mean, there's little variation. So, please use this information as general. But, when you're calling your servicer now and you put your loan in forbearance, and let's say you put it in forbearance for 3 months and you can't make all 4 payments in the 4th month, they're going to have to start to take steps. The last thing a servicer or anyone in the mortgage industry wants to do is to foreclose on a home. It's super costly. It hurts everyone. It's not something that any servicer wants to do. They're not in the business to take property back and own property and try and get it sold. That's not what anyone wants. So they're going to go through many different steps, different solutions of, hey, what if we increase the payment $500 a month for however many months is going to be required until it's caught up? That's going to be a form of a loan modification. Or, hey, we're going to extend this 30-year term an extra 4 months. That's a different form of a loan modification. But all these things require delinquency, default. There's going to be notices on your credit report about you when this happens. So there are going to be solutions. Don't get me wrong. If you didn't make your payment for 6 months, if you didn't make your payment for 6 months and you can't make it in the 7th month and get all caught up, nobody's going to go take your home. That's not what we're saying. They're going to go through different steps that might require you to be 30 days late before they allow a loan mod. Your servicer's contracts and covenants might dictate that we can't do a loan modification unless you're at least 60 days delinquent. If anybody remembers back in 2008, 2009, during the housing crisis, when people wanted a short sale or they wanted a loan modification, they were often told, hey, we can't do this until you're 60 days late. Well, 30 days late, 60 days late, credit score plummets, affects everything else in their life. And all of a sudden they're waiting 2-3 years to get out of this credit jail and to get another loan in the future. And there's many people that went through that in the housing crisis. So, they're going to have solutions, but the solutions are going to cause credit problems for you on all aspects of your life. And that's really the message we want to get out.
But to get out of it, there's definitely a solution. There's going to be a solution that they'll go through, but it's really on a case-by-case basis, right? There's no standard.
There's no one size fits all.
They will have to go through the process with their lender that they're making their payments to in order to really determine what their plan is to get out. And so there are solutions. Some are better than others, and some may impact their credit a little bit more than others as well, right? So we don't know that. But the main thing is, I believe, is to communicate everything you can to your lender and be upfront with them, call them, answer the calls, and be in constant communication so that you know that you're building the plan to get you out of forbearance. One of the questions that we have here is, what are the steps to get off of forbearance and off your record if no longer affected, and then how long does it last? And so go ahead.
Yeah. So if there's two camps. There's somebody that really needs it, and then there's somebody that's strategically trying to take advantage of the provision in the CARES Act. And, if somebody put their loan in forbearance just in case, because they're not sure if they're going to lose their job or not, they haven't lost their job, but they wanted to take advantage of this provision, and they're saying, but I'm not late yet, I haven't missed a month, so my credit report's going to report that I made the payment because I did. And you went and put your loan in forbearance, you can call your servicer, and you should be able to call your servicer and say, hey, I didn't understand everything, and I want to take my loan out of forbearance. We made the decision that, we rearranged our budget. We were educated about what all this forbearance information means and the consequences of it. And we changed our mind and how we're going to handle this. And we're going to continue to make our payments. We haven't missed one. Please take my loan out of forbearance. That can happen. And then, we're going to pull a credit report. If you wanted to get a loan or an auto loan or a credit card or another mortgage in 30 days, 45 days, 60 days, whenever a creditor pulls your credit, they're going to see that you made every payment, your payment history is solid, your loan's not in forbearance, and it's going to be fine. But as soon as you miss a window of making a 30-day payment, if somebody put their loan into forbearance and they've already missed a payment, it's the toothpaste is out of the tube, as we say. So
yeah. So the sooner you can get out, the better. And then we'll see how that impacts the credit report. Is there anything else that you believe is really important to get the message out, Sam? Consumers just don't know about forbearance and that they need to know?
Well, I just think that, it's very important to really understand from the servicer your options. It's really important to understand, how they're going to treat it, what they're going to do in 6 months if you don't make all the payments, if you did exercise forbearance. I just think it's important for people to fully understand. But the biggest message for the people that still are working, still have their full pay. They still have the ability to repay, and they can. I just want them to know, like, this has serious consequences if you just think you're taking advantage of it, and don't do it. That's the main thing. If you really need the help, you were impacted by COVID-19, the income that you were qualified on for your loan is no longer there. You don't have any other option. It's a really good provision to take advantage of, but don't take it. I mean, I really kind of wish that they would have, made it so that you can go in forbearance as long as you prove the hardship. The provision didn't allow that. Otherwise, somebody that called and said, no, I'm still working. No, my pay wasn't reduced. No, everything's normal. Well, then you don't need forbearance, and you shouldn't take advantage of this, because you can't, because it required a hardship and you don't have one. So there's a lot of opinions out there. I believe the government wanted to make this as simple as possible and easy as possible for everyone, so that everyone's heart was in the right place. It's just, looking down the road into the future and people thinking that they did something smart, and then all of a sudden, realizing how much this negatively affected their entire credit world and budget and future opportunity is something that it really needs to be taken seriously.
Well, this has been great, and I appreciate you actually sharing your information, Sam. Been a lot of fun. You've got a lot of fans. I can tell you, they're all kind of coming on here. You got Randy and Kelly and Gina and Leslie, and they're all very.
Oh, that's my mom. What's up, Mom?
The mom. Say hi, Mom.
Mom, keep paying your mortgage.
No, are you going to help her? I mean, you should help her.
Yeah, she's in good shape.
She's in good shape. Okay, yeah. Good. So anyway.
We have a whole team. We have a whole team of awesome mortgage experts here that make sure our friends, family, past clients, future clients, all of our realtor partners. I mean, the housing market bill is still really, really strong. We're probably, it's very local, but in general, the appreciation rates that were once projected are probably going to be a little bit less. Different areas have been affected by the COVID-19 in different ways, but there still really is an imbalance in supply and demand. There's more people that need homes than there are homes. And when we talk about normal economics, prices usually rise when that happens. So we kind of expect a slight drop potentially in the near term, call it the near, next quarter, maybe quarter and a half. But I think it's going to be a pretty fast rebound, in my personal opinion. And people need to be prepared to take advantage of the market that is likely to come. And I think we have a lot of positive things to look forward to. I don't get into all the conspiracy theories about, the COVID-19. I know it's affected a lot of people from an economic standpoint and a physical standpoint. But I think we're going to come out of this sooner than later, and there's going to be a lot of good stuff going on.
Well, yeah, and we do believe rates are going to stay low. They're probably a little bit higher than they should be. We've talked a little bit about that, and we're actually having a refinance webinar next week. You can go to our website and find the information if you have any interest in it. And we're going to talk a little bit about this, but certainly being in forbearance prevents you from being able to refinance.
Correct.
All that. And we are very, very lucky, Sam, with our teammates. They're incredible, and it's allowed us to really help so many families, and then get our GH community with Jessica out there. It's been a ton of fun. So, Sam, looking forward to another session.
Yeah, Bill, let me just end with this. I mean, we have many clients that are in process to save money. Rates are historically low. If rates go lower, and people are taking steps to take advantage of where the market is right now, and they're saving money, great. We're going to close those loans, and they're going to start saving money immediately. If rates get 0.5% lower in the next 6 months, or 0.75% lower, we can just refinance them again at no cost. Anybody that's not in process, I urge them to get in process, get prepared. If you think about, just as a general number, if $6 trillion of refinances are trying to get through a $2 trillion mortgage machine, you want to be more prepared than everyone else. And that's what's likely going to happen. So I urge people to get with your lender. Let us pre-approve you. Let us get your loan ready. Let us get it approved. Let us be prepared so that if and when these rates hit rock bottom, or even now, so many people can save money right now, Bill, and we help people every day save money. And that's what's great about what we do. We help them save money. We help them get into their homes, which is the only place they can go right now, which makes our job even more fun right now. We love helping people. You know, we helped 165 families last month. There's a name behind every one of those numbers and a family, and they need that shelter and they need that home. So I just urge people to get prepared for opportunities in the future. I think home ownership is one of the best wealth building tools of all time. So, you know, just be prepared, get with your lender, get pre-approved, and be waiting, or lock in and start saving money immediately.
I say it in a little bit different way. I say, get on the bus, get all your stuff in so that you drive the bus, and then you can select when it's right for you to hit the button and say lock. And the nice thing about getting on the bus and getting it all pre-approved is you can lock on a shorter term lock, which typically will give you the best advantage for the interest rate. Short-term locks are better than the longer term locks. So get on the bus and you drive it, and we'll get you to the destination. So thank you all.
Awesome.
Sam, next time, can't wait. We'll probably
I urge everyone forward, share this, like it, comment on it, get it to everybody you know, so that anybody that was, you know, thinking they're doing the right thing by putting their loan in forbearance and saving a little bit of money, that's not happening. So get the message out.
So you ready for my signature? This is Gaylord out. Bye guys. Thanks everyone.